Structure your money, stabilize your life. Welcome to Kelly Sharing. I'm Kelly, sharing practical and thoughtful insights on money.
Recently, Washington State passed a very controversial tax proposal. If this proposal eventually becomes law and survives future legal challenges, starting in 2029, individuals earning more than $1 million per year may need to pay a 9.9% tax on income above that threshold. At first, this might sound like something that's far away from most people. But if you work in Seattle, especially in the tech industry, you probably already know quite a few people in these situations. For example, a very typical case would be a software engineer working at a tech company. Their income may come from multiple sources, such as salary, bonus, and RSU stock compensation. When these are combined together, it's actually not uncommon for their total annual income to exceed $1 million. For example, in Seattle tech industry, many senior engineers have a compensation structure that includes salary plus RSU vesting, and the total annual income in the range of $800,000 to $1.5 million is actually quite common. When that happens, any change in tax policy can have a very direct impact. But for many high-income professionals, the real question is actually not politics. The more practical question is this: if tax policies like this become more common in the future, is our financial structures actually prepared? If you are interested in topics like investing, tax structures, and wealth planning, don't forget to like this video and subscribe to my channel. I will continue sharing more insights about financial planning and wealth structure. In today's video, we will start from this piece of news and talk about an issue that many high-income professionals often overlook. Part 1. What exactly happened? Let's first take a simple look at what actually happened. Recently, the Washington State House passed a new tax proposal. Many media outlets have referred to it as a rich tax. Under the current proposal, starting in 2029, individuals earning more than $1 million per year will need to pay a 9.9% tax on income above that threshold. Let's look at a simple example. If someone earns $1.5 million per year, the portion above $1 million, which is $500,000, could be subject to the 9.9% tax. Supporters of the proposal argue that the additional tax revenue would help fund programs that support families and small business. However, critics have raised legal concerns. According to historical court rulings in Washington State, income has previously been defined as a form of property, and under Washington State law, property taxes must follow a uniform tax rate. Because of this, a tax specifically targeting high-income individuals may face legal challenges in the future. So at this point, this proposal could still go through legal disputes and political debates. Part 2. A bigger trend many people overlook. But in reality, what's truly worth paying attention to here is not just this single tax proposal. What matters more is much bigger trend. Around the world, more and more governments are beginning to target high-income individuals with higher taxes. In fact, many countries already operate under a progressive tax system, and even within the United States, this kind of discussions is not new. For example, states like California and New York, as well as several European countries, have increased taxes on high-income groups over the past decade. The reason behind this trend is actually quite simple. Among all types of taxes, income tax is one of the easier taxes to collect, as long as you earn a salary, bonus, or other forms of earned income. The tax system can easily check it. So when governments face increasing fiscal pressure, one of the most direct solutions is simply to increase income taxes. And for high-income professionals, this actually presents a stressful risk. Part 3. High income does not automatically mean financial security. Many people have a common misunderstanding. They believe that as long as their income is higher, their financial life must be secure. But in reality, for many high-income professionals, their financial structure is actually quite simple. Let's look at a very typical example. Imagine a software engineer working in the tech industry. Their annual income may come from several sources: salary, bonus, and RSU stock compensation. At first glance, the income level is very high. The financial structure behind it often looks something like this: income, mortgage payments, living expenses, taxes. As long as income continues to grow, everything seems to work just fine. But once policies change or economic conditions shift, this financial structure can quickly become very passive. This is why many high-income earners are actually very sensitive to policy changes, because their financial life depends heavily on income itself. Many people think the biggest risk for high-income professionals is unemployment, but in reality, the real risk many high earners face is structural risk. Part 4. Is there a way to reduce the impact of income taxes? A lot of people might ask, Is there a way to reduce the impact of income taxes? The first thing to understand is a very important fact. There is no simple way to completely avoid income taxes. If your income comes from wages, it will almost certainly be visible to the tax system. But what many people overlook is this. Tax is not only determined by how much you earn, it also determines how your income is structured. Different types of income are taxed very differently. Top 5. 3 common directions for tax planning. In wealth planning, there are usually 3 main approaches that can help reduce your dependence on income taxes. First, tax deferral through retirement accounts. This is the most basic layer. For example, 401k, traditional IRA, defined benefit plans. The primary purpose of these accounts is tax deferral, not tax elimination. The core idea is simple. You postpone paying taxes on income until a later time. By doing this, you reduce your taxable income today. Of course, this strategy only delays taxes. Taxes will still need to be paid in the future. Second, shifting income type. This is something many high-income families eventually begin to pay attention to. In the US tax system, different types of income are taxed differently. Generally speaking, there are 3 main categories. The first type is earned income. This includes salary and wages, and it usually faces the highest tax rate. The second type is investment income. For example, capital gains, dividends, these types of income often have lower tax rates. The third type is asset-generated cash flow. For example, real estate, business income. This type of income may allow for more deductions or tax adjustments. Because of this, many wealth planning strategies focus on reducing reliance on salary income and gradually allowing assets to generate cash flow. Third, tax-efficient financial structures. The third layer is something many people don't often encounter. Some financial structures are designed to be tax efficient. For example, tax advantage accounts, municipal bonds, and certain long-term financial structures that are designed with tax efficiency in mind. The goal of these structures is not to eliminate income, but to improve overall tax efficiency. Discussions like the proposed bridge tax in Washington state actually reminds us something important. Financial planning is not about predicting the future. Instead, it's about designing a more resilient financial structure before the future arrives. That way, whether policies change, economic conditions shift, or even your career evolves, your financial system can remain stable. If you are high-income professionals working in Washington state, or if your income structure is relatively complex, and you would like to review your financial structures more systematically, you can also schedule a consultation through the link below. If you find today's video helpful, feel free to share your thoughts in the comments about what you think of this proposed bridge tax. And don't forget to like this video and subscribe to my channel. I will continue sharing more insights about investing, tax planning, and financial structures. See you in the next video. Bye!